So just a reminder with Trump's event, it is closed press, so not expecting any live stream, but it's been pushed back to 1:30 p.m. Eastern Time. Surely expecting the Fed reverse repo operation data.
And folks, we've got the Fed decision coming up at 2 p.m. Eastern. Not expecting any change to policy here on rates or the run rate of quantitative tightening. Really expecting a kind of ho-hum press conference from Powell with him signaling that they're more likely to start cutting in September. But I think his big pivot moment is going to be in August during Jackson Hole.
$27 counterparties take $155.481 billion at Fed reverse repo operation.
We can see ahead of the Fed meeting, there is interest building in higher prices. The most active call strikes giving us a sense of that. You can also see there's a pretty large offer overhead just around 64.50, which also is giving us an indication that there's some interest in higher prices from here. So it'll be interesting to see how this event evolves. We've certainly seen some hedging flows ahead of the Fed, and that gives us a sense that also as the event is playing out, the rate decision or lack thereof, as well as the press conference, could give us a bit of a boost into these areas of interest in higher prices. The second most active call strike at the warm call, this offer area, and then the most active call strike at the hot call. All worth watching here. Going to pull the view in just a little bit more till we get closer to the event or we see some more price action. For now, things are likely to consolidate.
There's still no live video for Trump when he signs the VA Homeless Reform Bill Act.
Overall, likely to be a relatively uneventful
It's about
Fed
28
nest
minutes
day.
ago until we get the interest rate decision from the Federal Reserve, where they're expected to keep rates unchanged. Of course, reminder there's no SEP or summary of economic projections. Now, the previous rate statement on June 18th, they said that although swings in net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate remains low, and the labour market conditions remain solid, and inflation remains somewhat elevated. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. And also on the article that we have posted out of the prep, there is the previous FMC SEP projections that have been posted on there. First bit of investment bank views then from ANZ. They expect no change to the rate at the FMC's July meeting. They say labour market conditions are close to full employment and unemployment rate has been relatively stable between 4 and 4.2% over the past year. This has allowed the Fed to focus on price stability and patiently watch inflation data for signs that higher tariffs are leading to a persistent rise in pressures. FMC Governor Bowman and Waller have publicly stated they support a July rate cut, so a decision to hold is unlikely to be unanimous. In the past year, there have been two separate indications of dissents from governors, Bowman in September 2024 and Waller in March of 2025. Unlike this time, however, their previous dissents were hawkish. The last dissenting vote by a governor was in 2005. Before that was in the early 1990s, when two governors dissented at the same meeting. From intermeeting communications, we know that owing to elevated inflation uncertainty from tariffs, most voting members of the FMC want to see more data over the northern summer before considering changes to monetary policy. We'll be looking for some tweaks to the language in the FMC statement alongside any comments from Powell that signal the September meeting is live for a rate cut. For example, if he acknowledges the labour market is cooling or that there is room to support the labour market. On the inflation side, if Powell focuses on the trend disinflation in services, it might be interpreted as a sign that there is less concern about a negative spillover from tariffs to broader inflation outside of goods. If no signals come out of this meeting, Powell could later flag a shift to a resumption of rate normalization at the 21st, 23rd August Jackson Hole Symposium. And at that time, he will have more inflation and jobs data, as well as a resolution to where reciprocal tariff rates might land given the August 1st deadline. JP Morgan's Michelle, just commenting here, says that they expect 1%, possibly 2% at the Fed. Currently speaking on an interview on Bloomberg TV. White House economic advisor Hassett says data is consistent with the Fed cutting rates, and he respects the independence of Fed. Heads up, White House economic advisor Hassett, currently speaking on Fox News. Hassett says many economists think that the Fed has been too slow.
One thing I'm noting in the options market here is a pretty wide distribution of strikes between the two most active puts and calls, which to me suggests we will see some range expansion during and after the Fed.
And JP Morgan's Michelle, who's the global head of fixed income, says that uncertainty has cleared up to some extent. JP Morgan's Michelle says that we haven't seen the full impact of tariffs for the full quarter. Michelle adds that I think the Fed is likely on hold in September as well. Trump touts EU-Japan trade deals. We do have a video for you to watch. Shell says June inflation data showed the start to see pass-through. Trump says negotiating with other nations, and the rest will receive a bill.
Seeing S&P 500 futures push above this point of control level will be interesting to see what the initial reaction is. Usually we get a fair amount of volatility.
Trump speaking live. Michelle says, I think Powell is going to reiterate the bias to ease.
That overhead offer just came off the books here.
Trump says Powell probably won't lower rates today. So going back to then the investment bank fees then for the Fed rate decision, ING, they say the market is currently pricing virtually zero chance of a rate cut, despite Trump pushing the Fed to lower interest rates immediately, and two of his appointees to the Federal Reserve, Waller and Bowman, saying they could support such action. However, the rest of the committee feels they have time to wait, especially in light of the recent firmer than expected June jobs report and ongoing uncertainty about how inflationary the president's tariffs will be. So they say the inflation has been well behaved recently, posting 0.1%, 0.2% month-to-month readings between February and May, but we always suspected it would be 3 months from April to May before the tariffs showed in the data. That means the July, August, September CPI reports, where we see the potential for 0.4% month-to-month or even 0.5% prints. The Fed was stung by the criticism after suggesting the post-pandemic supply shock price hikes would be transitory, only for inflation to hit 9% in 2022. It will not want to cut rates on a hunch and only have to backtrack again if inflation becomes more persistent. As such, we believe this meeting will be a non-event with rates left on hold and quantitative tightening left likely unchanged. German Finance Minister urges cabinet ministers to cut spending to close budget gap of over 30 billion euros in 2027. This is in an interview with Hard Tagesthemen. As Germany's Finance Minister Klingbeil make those comments. So let's go into the Q&A session now with Trump. And just reading through the final bit of research then from investment bank views, Goldman Sachs says that the FOMC is set to leave the Fed funds rate unchanged at this meeting. The statement is likely to acknowledge the softer growth pace in the first half of the year, but is unlikely to offer a strong hint about September. Governor Bowman and Waller have indicated that they would like to cut and are likely to dissent in the press. The press conference, Powell will probably be asked about the two-cut baseline implied by the median June dot. Trump says, just a headline here now, Trump says keeping interest rates high is hurting people. Going back to the investment bank view then, so they said that Powell will probably be asked about the two-cut baseline implied by the median June dot, and he will likely acknowledge it, but note there are still 2 rounds of inflation and employment data ahead of the September meeting, and reiterate that decisions will be made on a meeting-by-meeting basis. So Goldman Sachs continues to expect 325 basis point rate cuts this year, September, October, and December, followed by 2 more in 2026 to a terminal rate of 3 to 3.25%. They say our Fed funds rate scenario analysis implies that our probability-weighted Fed forecast remains dovish relative to market pricing.
One area worth noting ahead of the Fed here is we're seeing a large amount of unusually aggressive call sweeps in single stocks and ETFs, especially when compared to puts, which pale in comparison. This tells me there's a lot of optimism ahead of this Fed. There's many speculative names being bid as well. So it looks like the market is, at least via these participants, expecting an upside resolution.
September. 10 minutes away from the top of the hour now, where we expect the US interest rate decision. Forecast is for no change, prior force for 5%. We get the FOMC rate statement. Remember, we don't get the SEP, we get that at the next meeting. Trump says that Powell is too late, even if he does it today. Trump says BRICS is an attack on the dollar. And it says that India tariffs is over BRICS and trade deficit. And adding that India doesn't do much business with the US. Trump says we're talking to India now and we will see what happens. So Trump says, you'll know at the end of the week. So it says, we'll see what happens with India. You'll know at the end of the week. Trump says Canada has been charging our farmers for years. And Trump says that we're negotiating with India right now. Five minutes ago now until we get the Fed rate decision. Forecast is for no change. Prior force support 5%. We also get the Fed rate statement as well.
Could see liquidity on the order book really drying up here ahead of the Fed rate decision. This is one of the things that can promote a little more volatility in the reaction function of markets because there's simply not the bids and offers to absorb flow. It's also why it's pretty important to be careful trading ahead of these decisions.
Trump says that we're dealing with a lot of leaders on tariffs today. And we're moving along well with China. And adds that I think we'll have a very fair deal with China. One minute ago now till we get the FMC rate decision. And Trump concludes his remarks at the bill signing event. 10 seconds. No change, no change. Rate remains unchanged at 4.5% as expected. Fed says economic growth moderated in the first half of the year. Governors Waller and Bowman dissented in favor of rate cut. Fed removes language saying uncertainty has diminished. Fed says inflation remains somewhat elevated, labor market conditions remain solid, and recent indicators suggest growth of economic activity moderated in the first half of 2025. Unemployment rate remains low, labor market conditions remain solid. Just keep an eye on the market reactions here. Dollar seeing some downside movement. There's a little bit there. And the S&P 500 did see a little bit of movement towards the upside. So the Dixie holding on to gains after the FOMC. White House says Trump signed a proclamation to address effects of copper imports on America's national security. As said with the S&P 500 and Nasdaq 100 climbing to session highs. I'm just reversing that move towards the upside now. We have also posted out the FOMC rate statement as well on the feed for you to read through.
As expected, a bit of a nothing burger from the Fed. We haven't yet seen liquidity come back to the order book yet, but we do see that offer back live, a little smaller at 64.50,
Treasuries
and
pair
initially
loss after
a positive
Fed holds rates
reaction.
steady with dissent. So again, you had Waller and Bowman that preferred to lower the Fed funds rate by a quarter point. Trump says proclamation imposes universal 50% tariffs on imports of semi-finished copper products and copper-intensive derivative products effective August 1st. Seeing the US Treasury 2 10-year yield curve steepens after Fed statement. And so the US 2-year Treasury yields trim rise in wake of Fed statement, last flat at about 3.879%. Spot gold unchanged after the Fed rate decision, last down about 0.7%. The White House says Trump signed an executive order implementing an additional 40% tariff on Brazil. Trump signed an executive order implementing an additional 40% tariff on Brazil, bringing total tariff amount to 50% for Brazil. As a reminder, with Trump's proclamation on copper imports, it was announced in early July. Traders still fully price in at least one 2025 Fed rate cut. JP Morgan's Michelle says that we have to pay attention to the two dissents. White House says that de minimis exemption suspension effective August 29th. JP Morgan's Michelle says that I expect Powell to say not much disagreement in actuality. So just the US with the new US tariff order for Brazil cites Bolsonaro persecution. We have posted out the live stream of the FOMC press conference. Remember, that's at 2:30 p.m. Eastern Time.
So a little bit of turbulence there as Trump came out and
You did see the Brazilian real briefly sliding after US release.
put into effect those copper tariffs that had been talked about. So it's a 50% tariff on copper imports that are raw, semi-finished, and copper intensive. And that did help pull the market down just a little bit as the Fed decision was coming across the wires. We did have two dissenters as expected, Bowman and Waller, both probably vying for Powell's job next May, saying that they would have supported cuts this meeting. Overall, however, outside of what I've posted on my Twitter feed dissecting some of the information the Fed's released, they're still saying that inflation is elevated. They don't seem to be in a rush to do any cuts at this time. I think the first cut we would see this year around September. That's also what the Fed Watch tracker from CME is suggesting, about a less than 60% chance of a 25 bip cut in September and then another in December for a total of 50 bips in 2025. And we're seeing some evolution of those probabilities now. Futures are implying traders now see a 68% chance of a cut in September and a 65% chance of another cut in December. Those odds rising now.
Corporate America is learning how to absorb tariffs.
The White House say copper input materials and copper scrap are not subject to the 232 or reciprocal tariffs.
And Jerome Powell expected to start speaking at just about 2:30 p.m. Eastern. The market reaction so far quite subdued.
So the US ends duty-free de minimis for low-value shipments.
minutes ago now to read the FMC press conference with Powell. Remember, the video is on the feed for you to watch.
Again, a relatively subdued reaction in the markets to what was ostensibly a non-event. So I suppose it all makes sense, but we did see a lot of attempts to front run this with aggressive call sweeps and a number of speculative names, but we're not really seeing any sort of reaction here. My sense is now the market is waiting for Powell to speak before removing hedges to see if there's any outliers, any surprises from the chair. FedEx drops amid volume spike, last down about 2.8%. Bank of America's senior US economist, Babe, says that we still have an inflation problem, even if Waller is right. Five minutes ago now to get the FMC press conference with Powell. The video is on the feed.
also heads up White House digital asset report gets published. We do have the link. We'll pop it out for you in the feed. And JP Morgan's Michelle says effective tariff rate is to settle at 18 to 20%. One minute to go now till we expect the press conference to begin. And Fed Powell's press conference begins.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge, but it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors in residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who, I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think, all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. You know, we're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, you know, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, you know, to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, you know, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that, that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's a kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that. But if we have to make do with what we have, but I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate. But it's true, and it was, again, right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around all the way around the table. Everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, you know, well argued, very thoughtfully argued all around the table, good arguments, and you know, it's a situation where an unusual situation. The economy is in you know, good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, you know, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. You know, I said that's why we think policy should be restrictive, is because, you know, inflation is above target. When we have risks to both goals, and one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So you have to, that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more you know, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and you know, we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff, Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but you know, GDP is bumpy quarter to quarter, half to half, and often gets revised, you know, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, you know, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those it took to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
And that wraps up the press conference from the Federal Reserve, starring our main man, Jerome Powell, who gave us a lot to unpack here. I think one of the most important things we heard is that the certainty surrounding a rate cut coming as early as September has dropped, that this is a Fed that is indecisive. They're using the data-driven narrative to justify sitting on their hands, saying there's still upside risks to inflation because of the tariffs, but also saying the economy is showing some signs of slowing, led by slowing consumer spending. Essentially saying there are risks to both sides of their mandate, maximum employment on the one hand, price stability on the other. And so this is a chair that did everything he could to walk back expectations of any degree of certainty. Earlier, before the Fed started talking, I remarked that we had seen this growing divergence between the top two put and call strikes, saying that we'd probably see some range expansion. We've certainly got that. And we see put flow has also picked up pretty markedly here. So we're going to be watching as we get to the market close, and then we're going to be covering earnings after the market close. So stay tuned.
The US State Department sanctions entities involved in Iran oil trade. Futures now showing a 45% chance of a September 25 basis point cut after Powell's no decision comments versus 68% seen before the comments. The US State Department sanctions 20 entities over Iran oil trade. Deputy US Treasury Secretary to Fox News says there is scope for the Fed to reduce interest rates.
Overall, we're seeing a market that's not particularly thrilled about what it sees as a U-turn from this Fed, but in reality, it's probably not really much of a U-turn. If we're taking an honest assessment, this has been a Fed that's been pretty clear that they haven't made any final decisions about policy. So the market did what it usually does. It got excited, started to front run what it was expecting of the Fed, looking for 2 cuts this year, one in September, one in December. We've seen the odds of those cuts come down pretty materially. Before the Fed meeting, it was about a 68% chance or so of a September cut. Now it's looking at a 45% chance. So the Fed policy statement came out. That statement informed the market such that it started to increase the chances of a September rate cut. Prior to the statement, it was about a 61% chance. After the statement, it rose to 68%. And then, following Powell's press conference, dropped to 45% in September. So we can see the market is repricing this Fed. This is a market that was hoping to see another 50 bips of cuts this year, now pricing in maybe 25 bips of cutting in December. So something that's worth watching here, probably going to get President Trump out there talking more about too late Powell. But at the end of the day, I think that Powell is also doing what he can to try to at least maintain the image of some degree of Fed independence. Under pressure from Trump to cut, Powell's holding steadfast and essentially saying he's driven by data. Think what you will of the Fed or Powell. I'm personally no fan of either one, but I will at least say that's what it appears to be.
Ticker HIMS HIMS. So Tim O'Connor announces he is long HIMS. Share seeing an increase of activity.
And just after the close, we've got Microsoft earnings coming up. We're going to set up to start covering those earnings. So stay tuned. I'll have some more information about that be posting to my feed, but for those that are listening in, give me one moment. I'll have the estimates for you. We've got Microsoft earnings expected out at just about 4:05 p.m. Eastern with EPS of $3.37 and revenue of $73.89 billion expected. We'll be covering that, the price reaction, and the conference call. And for whatever reason, this is Microsoft's fourth quarter, the final quarter of their fiscal year for 2025 that they will be reporting earnings for. So I know that sometimes can confuse people a little bit because it, for most companies, is the second quarter if we're looking at the calendar year. But Microsoft's fiscal year has ended for 2025. So in their first quarter of their fiscal year for 2026, and we're getting the fourth quarter 2025 earnings out after the close here. And that conference call will be coming up at about 5:30 p.m. Eastern, 2:30 p.m. Pacific time. Typically, it runs about an hour, and that's what they've blocked off for their time for this call, once again, for the fourth quarter of 2025 for Microsoft's fiscal year. We are approaching the close here for the broader markets. S&P 500 futures trading around 6379.50. And this has been a relatively negative reaction to Powell, but if we consider that the S&P is only down a fraction of a percent here, really not anything to be too excited about on either side of the ledger. You can see S&P 500 cash down about 1/3 of 1%, NASDAQ about break even, Russell's taking it on the chin, down just about 1% here, and the Dow down 0.6 of 1%. Nvidia, Broadcom, Palantir, Google, Netflix, and others still green, including AMD. The rest of the S&P 500 heat map relatively red. Across U.S. listed equities, 74.2% declining, 22.9% advancing. So that is relatively nasty breadth that we're seeing. A lot of decliners overall, though we're starting to see a big pickup here in the futures as we approach the close. And once again, stay tuned for Microsoft earnings expected out at about 4:05 p.m. Eastern.
Ticker HYLN, Yankee Lima November, searching a spike in activity, social media circulations on a tweet from the CEO. Tweeting today, I had the opportunity to visit White House and meet with the newly formed Energy Dominance Council.
Coming up after the close. Earnings from QCOM Qualcomm. Qualcomm expecting $2.71. That's right at about 4 o'clock. WDC Western Digital, $1.47. EBAY eBay, $1.30 adjusted. Letter F Ford at 405, 31 cents. HOOD Robinhood, expecting 30 cents. META Meta, $5.86 adjusted. Microsoft at 405. MSFT, $3.37. CVNA Carvana at 410, $1.06. Donald Trump on Truth Now says we're very busy in the White House today working on trade deals. I've spoken to the leaders of many countries. I will be meeting with the South Korean trade delegation. Concluded a deal with Pakistan. That's from President Trump. 1 minute to the U.S. market close. TTEK 43 cents. The estimate on TTEK was 38 cents. Tango Tango Echo Kilo. Qualcomm is out. Qualcomm reporting 277. The estimate was $2.71. Sales of 10.365 billion. The estimate was 10.333 billion. Sees Q4 adjusted earnings of $2.75 to $2.95 versus the $2.82 estimate. Qualcomm sees sales of 10.3 billion to 11.1 billion versus the 10.57 billion estimate. Sees Q4 GAAP earnings of $2.23 to $2.43 versus the $2.42 estimate. That's Quebec Charlie Oscar Michael. CTSH, Cognizant Technology Solutions, reporting adjusted earnings of $1.31. The estimate on CTSH was $1.26. That's a beat for Charlie Tango Sandy Hotel. PTC, adjusted earnings of $1.64. The estimate was $1.21, so that's a beat for Papa Tango Charlie. SFM, Sprouts Farmers Market, $1.35. Sandy Foxtrot Michael. The estimate was $1.23, so that's a beat for Sandy Foxtrot Michael. DXCM, Dexcom, 45 cents. The estimate was 44 cents, so that's a beat for Delta X-Ray Charlie Michael. MSFT, Microsoft reporting. Microsoft reporting revenue of $76.4 billion. The estimate on Microsoft was $73.797, so that's a beat for Microsoft on revenue. $3.65 in earnings. The estimate was $3.37, so that's a beat for Michael Sandy Foxtrot Tango. MSFT. HOOD, Robinhood. Robinhood reporting. Waiting for those numbers. ARM Holdings reporting. Revenue of 1.05 billion for ARM Holdings, Alfa Romeo Michael. The estimate was 1.054 billion. EBAY, eBay reporting. eBay reporting adjusted earnings of $1.37. The estimate on eBay was $1.30. That's a beat for eBay. Revenue of 2.73 billion. The estimate was 2.64 billion. That's a beat for Echo Bravo Alpha Yankee. META, Meta, $7.14. The estimate on Meta was $5.86. That's a beat. Revenue 47.5 billion. The estimate was 44.5 billion. So that's a large beat for Meta. Shares of Meta are spiking here sharply. Meta $736, up about $42 now, continuing to spike here. META, Meta, on that very strong report. $741, $742 now on Meta, continues to spike here. $748 now on Meta, continuing. Ford, adjusted earnings of 37 cents, letter F. The estimate on Ford was 31 cents. Revenue $50.2 billion. The estimate on Ford was 42.7 billion for letter F. Robinhood, 42 cents, HOOD. The estimate on Robinhood was 29 cents, so that's a beat. Revenue 989 million. The estimate was 898 million. So that's a beat for Robinhood. CVNA Carvana, $1.28. The estimate was $1.06. Revenue 4.84 billion. The estimate 4.5 billion. That's a beat. Microsoft will provide guidance on earnings conference call and webcast. That's Michael Sandy Foxtrot Tango. PBI Pitney Bowes reporting 17 cents. The estimate was 27 cents, so that's a miss for Papa Bravo India. GNW Genworth, 16 cents. The estimate was 12 cents for Gulf November Whiskey. $761 now on Meta, up about $66. OSRH, OSR Holdings, provides update on Worry IO term sheet and share exchange structure. That's Oscar Sandy Romeo Hotel share spiking. mRNA, Moderna gets European Commission approval for updated COVID-19 vaccine targeting SARS-CoV-2 variant, LP.8.1. That's mRNA. WDC Western Digital, $1.66 beats the $1.47 estimate. Sales of $2.605 billion beats the $2.45 billion estimate for WDC Western Digital. Shares hitting 74.55 at the high for WDC. Shares of NVIDIA spiking 181.50 at the highs for NVIDIA after hours now. That is a new all-time high for NVIDIA. $5.51 on Microsoft, up about $38, new all-time high for Microsoft. MGM reported 79 cents. The estimate 50 cents. Sales of 4.41 billion, beating the 4.29 billion estimate for Michael Golf Michael. ALL Allstate reported $5.94. The estimate on Allstate was $3.23. Revenue of $16.6 billion. The estimate $15.2 billion. So that's a beat for Alpha Lima Lima. Microsoft 555.86 to highs now. Following their report, Michael Sandy Foxtrot Tango new all-time high. Meta off the highs now at 765.50. Hit a high of 772.50 for Meta, META. HST, Host Hotels, reporting 57 cents FFO. The estimate was 52 cents, so that's a beat for Hotel Sandy Tango, HST. FMC, 69 cents. The estimate was 61 cents, so that's a beat on the adjusted number. For Foxtrot Michael Charlie, CGNX Cognex, 25 cents. The estimate was 23 cents, so that's a beat for Charlie Golf November X-Ray. RDN rating $1.01. The estimate was 98 cents. That's a beat for Romeo Delta November. ALGN, Align Technology, following the report, the share was sold off sharply, down about $64. Fully McGolf, November. Company missing on earnings and on sales. That's ALGN.
Greetings and welcome to the Microsoft Fiscal Year 2025 Fourth Quarter Earnings Conference Call. At this time, all participants are in a listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce Jonathan Nielsen, Vice President of Investor Relations.
Good afternoon, and thank you for joining us today. On the call with me are Satya Nadella, Chairman and Chief Executive Officer, Amy Hood, Chief Financial Officer, Alice Jolla, Chief Accounting Officer, and Keith Dolliver, Corporate Secretary and Deputy General Counsel. On the Microsoft Investor Relations website, you can find our earnings press release and financial summary slide deck, which is intended to supplement our prepared remarks during today's call and provides the reconciliation of differences between GAAP and non-GAAP financial measures. More detailed Outlook slides will be available on the Microsoft Investor Relations website when we provide Outlook commentary on today's call. On this call, we will discuss certain non-GAAP items. The non-GAAP financial measures provided should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with GAAP. They are included as additional clarifying items to aid investors in further understanding the company's fourth quarter performance, in addition to the impact these items and events have on the financial results. All growth comparisons we make on the call today relate to the corresponding period of last year unless otherwise noted. We will also provide growth rates in constant currency, when available, as a framework for assessing how our underlying businesses performed, excluding the effect of foreign currency rate fluctuations. Where growth rates are the same in constant currency, we will refer to the growth rate only. We will post our prepared remarks to our website immediately following the call until the complete transcript is available. Today's call is being webcast live and recorded. If you ask a question, it will be included in our live transmission, in the transcript, and in any future use of the recording. You can replay the call and view the transcript on the Microsoft Investor Relations website. During this call, we will be making forward-looking statements, which are predictions, projections, or other statements about future events. These statements are based on current expectations and assumptions that are subject to risks and uncertainties. Actual results could materially differ because of factors discussed in today's earnings press release, in the comments made during this conference call, and in the risk factor section of our Form 10-K, Forms 10-Q, and other reports and filings with the Securities and Exchange Commission. We do not undertake any duty to update any forward-looking statement. And with that, I'll turn the call over to Satya.
Thank you, Jonathan. It was a very strong close to what was a record fiscal year for us. All up, Microsoft Cloud surpassed $168 billion in annual revenue, up 23%. The rate of innovation and the speed of diffusion is unlike anything we have seen. To that end, we are building the most comprehensive suite of AI products and tech stack at massive scale. And to provide more context, I want to walk up the stack, starting with Azure. Azure surpassed $75 billion in annual revenue, up 34%, driven by growth across all workloads. We continue to lead the AI infrastructure wave and took share every quarter this year. We opened new DCs across 6 continents and now have over 400 data centers across 70 regions, more than any other cloud provider. There is a lot of talk in the industry about building the first gigawatt and multi-gigawatt data centers. We stood up more than 2 gigawatts of new capacity over the past 12 months alone, and we continue to scale our own data center capacity faster than any other competitor. Every Azure region is now AI first. All of our regions can now support liquid cooling, increasing the fungibility and the flexibility of our fleet. And we are driving and riding a set of compounding S-curves across silicon, systems, and models to continuously improve efficiency and performance for our customers. Take, for example, GPT-4o family of models, which have the highest volume of inference tokens. Through software optimizations alone, we are delivering 90% more tokens for the same GPU compared to a year ago. Beyond the AI fleet, we continue to build our commercial cloud to address customers' unique data residency and sovereignty requirements. This quarter, we introduced the Microsoft Sovereign Cloud, the industry's most comprehensive solution spanning both public and private cloud deployments. All of this innovation is driving our strong results. We saw accelerating growth from migrations again this quarter. Nestle, for example, migrated more than 200 SAP instances, 10,000 plus servers, 1.2 petabytes of data to Azure with near zero business disruption. That makes it one of the largest and most successful migrations in business history. The next big accelerator in the cloud will be quantum, and I'm excited about our progress. In fact, earlier this month, we announced the world's first operational deployment of a level 2 quantum computer in partnership with Atom Computing. This is how we will continue to think and make investments with decade-long arcs while making progress every quarter. The next layer is data, which is foundational to every AI application. Microsoft Fabric is becoming the complete data and analytics platform for the AI era, spanning everything from SQL to NoSQL to analytics workloads. It continues to gain momentum with revenue up 55% year over year and over 25,000 customers. It's the fastest growing database product in our history. Fabric OneLake spans all databases and clouds, including semantic models from Power BI, and therefore it is the best source of knowledge and grounding for AI applications and context engineering. Azure Databricks and Snowflake on Azure both accelerated as well. Cosmos DB and Azure PostgreSQL are both powering mission-critical workloads at scale. OpenAI, for example, uses Cosmos DB in the hot path of every ChatGPT interaction, storing chat history, user profiles, and conversational state. And Azure PostgreSQL stores metadata critical to the operation of ChatGPT as well as OpenAI's developer APIs. This year, we launched Azure AI Foundry to help customers design, customize, and manage AI applications and agents at scale. Foundry features best-in-class tooling, management, observability, and built-in controls for trustworthy AI. Customers increasingly want to use multiple AI models to meet their specific performance, cost, and use case requirements. And with Foundry, they can provision inferencing throughput once and apply it across more models than any other hyperscaler, including models from OpenAI, DeepSeek, Meta, xAI's Grok, and very soon Black Forest Labs and Mistral AI. We sim-shipped 15 models from OpenAI alone on Foundry this year, providing same-day access to state-of-the-art models deeply integrated with our infrastructure and tools. And we are seeing accelerated adoption of our new Foundry agent service, which is now being used by 14,000 customers to build agents that automate complex tasks. For example, NASDAQ is using Foundry to build agents that help customers prepare for board meetings, cutting prep time by up to 25%. All up, 80% of Fortune 500 already use Foundry. And when we look narrowly at just the number of tokens served by Foundry APIs, we processed over 500 trillion this year, up over 7x. This is a good indicator of true platform diffusion beyond a few head apps and services. Talking about the app layer, these applications are becoming embedded in our daily work and life. Our family of Copilot apps has surpassed 100 million monthly active users across commercial and consumer. And when you take a broader look at the engagement of AI features across our products, we have over 800 million monthly active users. Microsoft 365 Copilot is becoming the new way to organize work and workflow and work artifacts. We rolled out our biggest update to Microsoft 365 Copilot to date this quarter, bringing together chat, search, create, notebooks, as well as agents into one intuitive scaffolding. With this innovation and continued product improvements, we are seeing real momentum. Customers continue to adopt Copilot at a faster rate than any other new Microsoft 365 suite, with strong usage intensity as shown by our week-over-week retention. And we saw the largest quarter of seat ads since launch, with a record number of customers returning to buy more seats. Barclays, for example, will roll out Microsoft 365 Copilot to 100,000 employees globally, following a successful initial deployment of 15,000. UBS is expanding its deployment to all of its employees after initially rolling it out to 55,000 of them. And Adobe, KPMG, Pfizer, Wells Fargo all purchased over 25,000 seats this quarter. Tens of thousands of organizations have already used our researcher and analyst deep reasoning agents in the first weeks of availability, and we have introduced group-level agents in teams like Facilitator and Interpreter, which generate real-time translation and notes in meetings. Hundreds of partners like Adobe, SAP, ServiceNow, and Workday have built their own third-party agents that integrate with Copilot and Teams. We are also seeing more customers use Copilot Studio to extend Microsoft 365 Copilot and build their own agents. This year, customers created 3 million agents using SharePoint and Copilot Studio. And with Copilot tuning, they can easily create agents fine-tuned on their company's data, workflow, and style that reflect their unique tone, language, and expertise. We're also seeing great traction among specific roles and functions, starting with developers. GitHub Copilot continues to have great momentum in IDE with agent mode and new form factors like Coding Agent, which is capable of asynchronously executing developer tasks. We have 20 million GitHub Copilot users. GitHub Copilot Enterprise customers increased 75% quarter over quarter as companies tailor Copilot to their own code bases, and 90% of the Fortune 100 now use GitHub Copilot. More broadly, GitHub usage and repos are seeing explosive growth because of AI. AI projects on GitHub more than doubled over the last year. The surge in vibe coding projects and AI coding agents, whether it is Claude Code, Codex, Cursor, or GitHub Copilot, are generating more pull requests and more repos on GitHub. And our code review agent is being used heavily across the platform, performing millions of code reviews each month. In healthcare, we had a breakout year for Dragon Copilot. Customers used our ambient AI solutions to document over 13 million physician-patient encounters this quarter, up nearly 7x year over year. For example, at Mercy Health System, more than 1,000 physicians are already using Copilot to reduce administrative burden so that they can focus on providing better care. They have saved more than 100,000 hours to date and plan to expand to all 5,000 providers. As one physician put it, the best thing to happen to my practice in 10 years. And in security, we were the first in the industry to introduce agents to help defenders autonomously handle high-volume security and IT tasks. More broadly, AI is driving a fundamental change in the BizApps market as customers shift from legacy systems to agentic business applications. Dynamics 365 took share this year, and we're winning customers in every industry, like Verizon with sales, Domino's Pizza Group with ERP, 1-800-Flowers with contact center. When it comes to consumer apps, we are innovating across all surfaces. In fact, on Monday, we introduced Copilot Mode in Edge. It's especially exciting to see the innovation coming back to browsers. Copilot Mode brings together Copilot Composer, Chat, Discover, Search, and Actions to build the next generation of browser for the AI age. Our Copilot consumer app also continued to see strong growth in engagement and successful sessions. And we are bringing Copilot to every Windows 11 PC. With Copilot Vision, you can share your screen with Copilot and get real-time insights and assistance on anything. And we are well positioned as we approach Windows 10 end of support in October, thanks to Windows 11 and Copilot Plus PCs, which offer customers compelling security as well as AI value. Talking about security, it underlies our cloud and AI infrastructure as well as our Copilots and agents. We have launched over 100 new capabilities over the past year. Just last week, we added a modern data lake to our SIM, Microsoft Sentinel, bringing together customer data across our first-party tools as well as third-party ecosystem, over 350 connectors. We're also extending the systems customers already use for governance, identity, security, and management to protect every AI agent. Entra now extends identity permissions, policies, and access controls to agents. Defender secures nearly 2 million Gen AI apps. Purview is used by 3/4 of the Microsoft 365 Copilot customers to protect their data. And all up, we now have nearly 1.5 million security customers and continue to take share across all major categories we serve. Before I wrap, I want to talk about two consumer businesses of ours with massive end-user reach, LinkedIn and Xbox. LinkedIn is home to 1.2 billion members with 4 consecutive years of double-digit member growth. All-up comments on LinkedIn rose over 30%, and video uploads increased over 20% this year. We continue to bring AI to every part of LinkedIn experience, introducing agents across hiring as well as sales. When it comes to gaming, we have 500 million monthly active users across platforms and devices. We are now the top publisher on both Xbox and PlayStation this quarter, with successful launches of Forza Horizon 5 and Oblivion Remastered. The Call of Duty franchise has never been stronger. 50 million people have played Black Ops 6. Total hours surpassed 2 billion. Minecraft saw record monthly active usage and revenue this quarter, thanks in large part to the success of the Minecraft movie. And we have nearly 40 games in development, so much more to come. We surpassed over 500 million hours of gameplay streamed via the cloud this year, and Game Pass annual revenue was nearly $5 billion for the first time. In closing, we are going through a generational tech shift with AI, and I have never been more confident in Microsoft's opportunity to drive long-term growth and define what the future looks like. With that, let me turn it over to Amy to walk through our financial results as well as the outlook.
Thank you, Satya, and good afternoon, everyone. This year, we delivered over $281 billion in revenue, up 15% year over year, which reflects the broad strength of our products and services. Operating income was over $128 billion, up 17% year over year, as we invested against the expansive opportunity ahead. And in our largest quarter of the year, we significantly exceeded expectations with strong execution by our sales and partner teams. As Satya shared, we're innovating faster than ever to deliver new value to our customers. This quarter, revenue was $76.4 billion, up 18% and 17% in constant currency. Gross margin dollars increased 16% and 15% in constant currency, while operating income increased 23% and 22% in constant currency. And earnings per share was $3.65, an increase of 24% and 22% in constant currency. For the first time, commercial bookings were over $100 billion, increasing 37% and 30% in constant currency on a strong prior year comparable. Strong execution across our core annuity sales motions, including healthy renewals, as well as an increase in the number of $10 million and $100 million plus contracts for both Azure and Microsoft 365, helped drive these results. Commercial remaining performance obligation increased to $368 billion, up 37% and 35% in constant currency. Roughly 35% will be recognized in revenue in the next 12 months, up 21% year over year. The remaining portion, recognized beyond the next 12 months, increased 49%. And this quarter, our annuity mix was again 98%. FX was roughly in line with expectations on total company revenue, segment-level revenue, COGS, and operating expense growth. Microsoft Cloud revenue was $46.7 billion, ahead of expectations, and grew 27% and 25% in constant currency. Microsoft Cloud gross margin percentage was slightly better than expected at 68%, down 2 points year over year from the impact of scaling our AI infrastructure, partially offset by continued efficiency gains in Azure and M365 Commercial Cloud. Company gross margin percentage was 69%, down 1 point year over year, driven by sales mix shift to Azure and the lower Microsoft Cloud gross margin noted earlier. Operating expenses increased 6% and 5% in constant currency, and operating margins increased 2 points year over year to 45%. Better than expected revenue growth, coupled with a focus on operating efficiently, drove the margin expansion. At a total company level, headcount at the end of June was relatively unchanged year over year. Now to our segment results. Revenue from productivity and business processes was $33.1 billion and grew 16% and 14% in constant currency, better than expected, driven by M365 commercial products and cloud services and M365 consumer products and cloud services. M365 commercial cloud revenue was ahead of expectations and increased 18% and 16% in constant currency, with 2 points of benefit from in-period revenue recognition. Business trends remained relatively stable to the prior quarter when excluding the end-period revenue recognition, with ARPU growth again driven by E5 and M365 Copilot. Paid M365 commercial seats grew 6% year over year, with installed base expansion across all customer segments, though primarily in our small and medium business and frontline worker offerings. M365 commercial products revenue increased 9% and 7% in constant currency, ahead of expectations, due to higher than expected Office 2024 transactional purchasing. M365 consumer cloud revenue was better than expected, increasing 20%, driven by ARPU growth following the January price increase and subscriber growth of 8%. LinkedIn revenue increased 9% and 8% in constant currency, with growth across all businesses, though Talent Solutions continues to be impacted by weakness in the hiring market. Dynamics 365 revenue increased 23% and 21% in constant currency, with strong execution in our core annuity sales motions, leading to growth across all workloads. Segment gross margin dollars increased 16% and 15% in constant currency, and gross margin percentage increased slightly, driven by the efficiency gains noted earlier, even as we deliver more AI features across our products and scale our AI infrastructure. Operating expenses increased 7% and 6% in constant currency, and operating income increased 21% and 19% in constant currency. Next, the Intelligent Cloud segment. Revenue was $29.9 billion and grew 26% and 25% in constant currency, ahead of expectations, driven by Azure and our on-premises server business. In Azure and other cloud services, revenue grew 39%. Significantly ahead of expectations, driven by accelerated growth in our core infrastructure business, primarily from our largest customers. As a reminder, new cloud and AI workloads are built and scaled using the breadth of our services. Revenue from Azure AI services was generally in line with expectations. And while we brought additional data center capacity online this quarter, demand remains higher than supply. In our on-premises server business, revenue decreased 2% and 3% in constant currency, ahead of expectations, primarily driven by transactional purchasing, which also has higher in-period revenue recognition. Enterprise and partner services revenue increased 7% and 6% in constant currency, with growth in enterprise support services partially offset by a decline in industry solutions. Segment gross margin dollars increased 17% and 16% in constant currency, and gross margin percentage decreased 4 points year over year, driven by scaling our AI infrastructure, partially offset by Azure efficiency gains noted earlier. Operating expenses increased 6% and 4% in constant currency, and operating income grew 23%. Now to more personal computing. Revenue was $13.5 billion and grew 9%, exceeding expectations, primarily due to Windows OEM, as well as Xbox content and services. Windows OEM and devices revenue increased 3% year over year, ahead of expectations, as inventory levels remained elevated. Search and news advertising revenue ex-TAC increased 21% and 20% in constant currency, driven by continued growth in both volume and revenue per search, as well as roughly 8 points of favorable impact from third-party partnerships, including the benefit of a low prior year comparable. And in gaming, revenue increased 10%. Xbox content and services revenue increased 13% and 12% in constant currency, driven by better than expected performance from first-party content and Xbox Game Pass. Segment gross margin dollars increased 15%. Gross margin percentage increased 3 points year over year, with improvement across all businesses. Operating expenses increased 4% and 3% in constant currency. Operating income increased 34% and 33% in constant currency, driven by continued prioritization of higher margin opportunities. Now, back to total company results. Capital expenditures were $24.2 billion, including $6.5 billion of finance leases, where we recognize the full value at the time of lease commencement. Cash paid for PP&E was $17.1 billion. The difference is primarily due to finance leases. More than half our spend was on long-lived assets that will support monetization over the next 15 years and beyond. The remaining spend was primarily for servers, both CPUs and GPUs, and driven by strong demand signals. Cash flow from operations was $42.6 billion, up 15%, driven by strong cloud billings and collections, partially offset by higher supplier payments. And this quarter, free cash flow was $25.6 billion. Other income and expense was negative $1.7 billion, primarily due to losses on investments accounted for under the equity method. Our effective tax rate was approximately 17%. And finally, we returned $9.4 billion to shareholders through dividends and share repurchases, bringing our total cash return to shareholders to over $37 billion for the full fiscal year. Now, moving to our outlook. My commentary for both the full year and next quarter is on a U.S. dollar basis unless specifically noted otherwise. Let me start with some full-year commentary for FY26. First, FX. Assuming current rates remain stable, we expect FX to increase full-year revenue growth and COGS growth by approximately 2 points and to increase operating expense growth by 1 point. Next, building on the strong momentum we saw this past year, we expect to deliver another year of double-digit revenue and operating income growth in FY26. We will continue to invest against the expansive opportunity ahead across both capital expenditures and operating expenses, given our leadership position in commercial cloud, strong demand signals for our cloud and AI offerings, and significant contracted backlog. Capital expenditure growth, as we shared last quarter, will moderate compared to FY25 with a greater mix of short-lived assets. Due to the timing of delivery of additional capacity in H1, including large finance lease sites, we expect growth rates in H1 will be higher than in H2. We remain focused on delivering revenue growth and increasing our operational agility, and as a result, we expect operating margins to be relatively unchanged year over year. And finally, we expect our FY26 effective tax rate to be between 19 and 20%. Now to our outlook for the first quarter. Based on current rates, we expect FX to increase total revenue growth by 2 points. Within the segments, we expect FX to increase revenue growth by roughly 3 points in productivity and business processes and roughly 1 point in intelligent cloud and more personal computing. We expect FX to increase COGS and operating expense growth by roughly 1 point. In commercial bookings, we expect healthy growth on a growing expiry base. Bookings growth will again be driven by strong execution across our core annuity sales motions and long-term commitments to our platform. As a reminder, larger long-term Azure contracts, which are more unpredictable in their timing, drive increased quarterly volatility in our bookings growth rate. Microsoft Cloud gross margin percentage should be roughly 67%, down year over year, driven by the impact of continuing to scale our AI infrastructure. We expect Q1 capital expenditures to be over $30 billion, driven by the continued strong demand signals we see. As a reminder, there can be quarterly spend variability from cloud infrastructure buildouts and the timing of delivery of finance leases. Next, to segment guidance. In productivity and business processes, we expect revenue of $32.2 to $32.5 billion, or growth of 14 to 15%, with roughly 3 points of benefit from FX, as noted earlier. In M365 Commercial Cloud, we expect revenue growth to be between 13 and 14% in constant currency, with business trends that remain relatively stable compared to the prior quarter. ARPU growth will again be driven by E5 and M365 Copilot. M365 Commercial Products revenue growth should be in the mid to high single digits. As a reminder, M365 Commercial Products includes both the Windows Commercial on-premises components of M365 Suites and Office transactional purchasing, both of which can be variable due to in-period revenue recognition dynamics. M365 Consumer Cloud revenue growth should be in the low 20s, driven by the January price increase. For LinkedIn, we expect revenue growth in the high single digits. And in Dynamics 365, we expect revenue growth to be in the high teens with continued growth across all workloads. For Intelligent Cloud, we expect revenue of $30.1 to $30.4 billion US dollars, or growth of 25 to 26%, with roughly 1 point of benefit from FX, as noted earlier. Revenue will continue to be driven by Azure, which can have quarterly variability in year-on-year growth rates depending on the timing of capacity delivery and when it comes online, as well as from in-period revenue recognition depending on the mix of contracts. In Azure, we expect Q1 revenue growth of approximately 37% in constant currency, driven by strong demand for our portfolio of services on a significant base. Even as we continue bringing more data center capacity online, we currently expect to remain capacity constrained through the first half of our fiscal year. In our on-premises server business, we expect revenue to decline in the low to mid-single digits with the ongoing customer shift to cloud offerings. In more personal computing, we expect revenue to be $12.4 to $12.9 billion US dollars. Windows OEM and devices revenue should decline in the mid to high single digits. We expect the elevated inventory levels at the end of Q4 to come down through the quarter in Windows OEM, although the range of potential outcomes remains wider than normal. Devices revenue should decline. Search and news advertising ex-TAC revenue growth should be in the low to mid-teens, down sequentially as growth rates normalize following the benefit from third-party partnerships noted earlier. Growth will continue to be driven by volume and revenue per search across Edge and Bing. Overall search and news advertising revenue growth should be in the low double digits. And in gaming, we expect revenue to decline in the mid to high single digits. Against a strong prior year comparable, we expect Xbox content and services revenue to decline in the mid single digits. Now back to company guidance. We expect COGS of $24.3 to $24.5 billion US dollars, or growth of 21 to 22%. An operating expense of $15.7 to $15.8 billion US dollars, or growth of 5 to 6%. Other income and expense is estimated to be negative $1.3 billion, primarily due to investments accounted for under the equity method. As a reminder, we do not recognize mark-to-market gains or losses on equity method investments. And lastly, we expect our Q1 effective tax rate to be between 19 and 20%. In closing, we finished the year with double-digit revenue and operating income growth and exceeded the FY25 operating margin commitment we shared a year ago. Our focus remains on investing in security, quality, and AI platform and product innovation that delivers value and opportunity to our customers. We are excited for FY26. With that, let's go to Q&A, Jonathan.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. And our first question comes from the line of Keith Weiss with Morgan Stanley. Please proceed.
Excellent. Thank you guys for taking the question, and congratulations on a fantastic end to FY25. I've been covering Microsoft for a while. I don't think I've ever seen a quarter where everything came together this well. So congratulations on that.
Thank you for calling Income Conferencing. The next available operator will be with you momentarily. Thank you for calling Income Conferencing. The next available operator will be with you momentarily.
So these are workload results that are invaluable for us to learn to build both the products as well as the platform. And then broadly, or rather over time, there will be broad diffusion. In fact, one of the things that Amy and I track is not just the head app usage, but also what's the sort of all the tier 2 applications that are being built. Audio is down, he said. So that speaks a little bit, Keith, to I think your question is as long as we have head apps shaping the platform, and then after that we have the broad diffusion happen, which in some sense both of those is what we're seeing. So I feel very good about being in decent standing going forward.
Thanks, Keith. Operator, next question, please.
The next question comes from the line of Mark Mordler with Bernstein Research. Please proceed.
Thank you. I'd also give you my congratulations. Amazing. I didn't know how you were going to beat last quarter, and you did it, so congratulations. And thank you for taking my question. Satya and Amy, we're now 2+ years into the Gen AI revolution, and adoption is still early and ramping. What do you think is the best way that software companies are going to be able to monetize AI for SaaS? Do you believe there are differences in monetization for horizontal, more general apps like M365 Copilot or Dynamics CRM Copilot versus very targeted capacities on the agentic side? And also, how should you think about the trajectory of SaaS AI margins over the long term? Thank you.
Yeah, I'll start, and Amy, you should feel free to add. I mean, if I just broaden out beyond just SaaS as a category, I think just like, the server to cloud transition was an expansion of essentially usage of servers. That is essentially what happened with the cloud, right? Which is we did a bunch of servers, except that the expertise required, the capital required, the time required to bring up servers, build it out, scale it, was just all hard. And so therefore, the market was a certain size, whereas with the cloud, you could sort of buy it with flexibility, you could burst, and you could spin up and spin down. The expertise required came down. So it was just, orders of magnitude. That's what's happening, So if you sort of even subscribe to this point of view that intelligence is basically log of compute, that means compute's going to grow, and you've got to use it as efficiently as possible to just keep creating intelligence. Now, how does it manifest beyond just the infrastructure? I kind of, to Keith's earlier question, I talked a little bit about how the infrastructure is getting shaped, data layer is getting shaped, the app server is getting built. These are all classic categories of infrastructure that will continue, but there will be an order or two of magnitude more. So literally, in fact, one of the other things we track is every GPU requires storage and compute. That ratio is another thing that is really exponential for infrastructure growth. So when you go to the app layer, the SaaS apps themselves are now building in effectively agentic and chat interfaces with intelligence, and they're also building autonomous agents. Agents are kind of like applications, like a database application, perhaps, but they are being used increasingly inside of a user interaction. I think a good example is GitHub Copilot. It got started as an code completions on an IDE. Then we added the chat interface to it. Then we added the agent mode to it. And now we have an autonomous agent, which in fact works completely asynchronously, right? So all those four things are now part of essentially GitHub. And by the way, it also turns out that every other tool that is also doing any form of coding is adding more and more GitHub repos. So if I had to think about GitHub monetization, we have an opportunity around just monetizing GitHub Enterprise, and then we have the ability to think about GitHub Copilot, and GitHub Copilot as with all these form factors. And so that's exactly the same thing that's happening with Microsoft 365. That's the same thing that's happening with Dynamics 365. So you have to be very open to taking your data tier, your business logic tier, and your UI tier, and sort of being more expansive in it. As long as you do that, it's just that usage goes up, and that's what I think shows up in the results.
And I think, Mark, if you wanted to think about, all the things in the layers that you talked about, is really we're seeing very similar monetization tools exist in this transition too, right? There's a per user logic, there's tiers of per user. Sometimes those tiers relate to consumption. Sometimes there's pure consumption models. I think you'll continue to see a blending of these, especially as the AI model capability grows. You'll end up with ways that teams are going to want to throttle that usage, use the best models for the best job. And I think the blending of these models will continue to be something we see on a go-forward basis.
Thank you. I appreciate it.
Thanks, Mark. Operator, next question, please.
The next question comes from the line of Karl Keirstead with UBS. Please proceed.
Okay, thanks. Satya and Amy, this is the second quarter in a row of pretty material Azure upside from what sounds like an acceleration in on-prem to Azure migration activity. I'm just wondering if you can comment on the plethora of customer conversations you've had, whether there are a couple of 2 or 3 specific catalysts that are driving that migration, and how durable a trend do you think that is? Thank you.
Yeah, there are 3 things that are really happening. One is the migrations. A good example would be what I referenced in my remarks with Nestle, with the SAP instances they moved along with a lot of the data that's associated with it and a bunch of servers. So that's kind of a classic example, I think, whether it's VMware migrations or migrations of SAP, or even just our own server migrations. They're pretty healthy, and as it turns out that we're still not anywhere close to the finish line, if at best maybe in the middle innings of that. The second thing that's also happening is cloud-native applications that are scaling. This is even excluding all of the AI stuff, just the classic cloud-native e-commerce company, let's say. These are scaling in a big way. And some of those customers were not on Azure previously, but now they're increasingly there because they have come for AI perhaps, but they now stay for more than AI. And so to me, that's another thing you see in overall what's happening across the Azure number. And then, of course, there are the new AI workloads. So those are 3 things that are all, in some sense, building on each other, but that's kind of what's driving our growth.
Got it. Thank you.
Thanks, Carl. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Satya, back to the strength across the board in the quarter. Was there anything that jumped out at you or surprised you that you didn't think you were going to see, but you did see in the quarter? The magnitude of upside, I think, had shocked many here.
Yeah, I don't know, Brent, if anything really surprised us, but I think what we're noticing in our own build out of these AI applications and in general is the platform's becoming more than here's a model and here's an API, make some calls, right? I mean, that's in some sense was a bit of the state of the art maybe even a year ago, whereas now you have essentially these very stateful app patterns that are emerging that require quite a bit of rethinking of even the app stack. I mean, take even the storage tier stuff, right? The degree of sophistication you have and, hey, how much of an index do you really want to build by pre-processing so that your prompt engineering or context engineering, as I call it, can be better and higher quality. So I think all of that is emerging. So when I look at a product like Azure Search, Fabric, and Cosmos DB, all of the things, the frameworks around it are just becoming robust to build serious applications. And so that's what I feel great about is the learning curve inside the company, outside the company, the diffusion of the stack, the speed with which that's emerging. That you can build applications is much faster, right? I always go back and say, hey, when a relational database came out, it took a while for people to build an ERP system, let's say. And this thing, we're kind of building pretty sophisticated applications at a very, very fast clip based on, I think, the degree of maturity that's emerging.
Thanks, Brent. Operator, next question, please.
The next question comes from the line of Raimo Lenschow with Barclays. Please proceed.
Perfect. Thank you. Congrats from me as well. I had one question around Copilot, and I'm obviously a happy user here at Barclays. If you think about it, the one thing that we're all realizing is that Copilot is the AI part, but data is becoming more and more important. And then from there on, we can start thinking about agents. What are you seeing in your customer conversations, Satya, about like that understanding that Copilot is actually just the starting point, and then from there on, it's becoming like much broader. Thank you.
Yeah, I think that's right. Even inside of Copilot, I'm sure you're seeing it, right? You now have analysts and researchers to just talk about two examples, and of course, people, all the third-party agents. So yeah, there is a lot more of just not request response. It's about spawning essentially applications that then go do work and come back. But the UI still remains very important, right? Even for asynchronous work, to instruct the asynchronous work, you need UI. And to monitor asynchronous work, you need UI. It may be different. It may not be a chat interface. And, of course, you need a way to then inspect what the asynchronous work is, right? So even take the example I was giving on GitHub. Even if you're not using GitHub Copilot to create the code check-in or the pull request, interestingly enough, we're seeing massive increase to GitHub Copilot code review agent, even if you used maybe Claude Code or whatever else to write the code. So that's, I think, what's happening across all of these systems. So you're absolutely right that it starts with some kind of a UI that's more chat focused, but it quickly goes beyond it, and you see it in M365, you see it in Dynamics 365, and you see it in GitHub.
Thank you.
Thanks, Raimo. Operator, next question, please.
The next question comes from the line of Kash Rangan with Goldman Sachs. Please proceed.
Hi, thank you very much. Amy, I want to acknowledge that I think a few quarters ago you said that you'll reach a point in time where you can accelerate Azure while slowing down CapEx, so you did it. But what is the outlook? When I looked at the CapEx guidance for the upcoming quarter, certainly I would view that as a positive indicator of the book of business you have for your cloud services. But how should we think about the shape of the curve of CapEx vis-a-vis Azure growth rate in the years ahead, particularly as I listen to Satya's comments on the AI stack consuming more and more infrastructure? Are we at a point where we're going to have to continue to do this and then we magically wait for inference and applications to kick in and therefore create a richer gross margin mix? Thank you so much for your comments and congrats on the quarter.
Thanks, Kash. Let me back up and first say, when you think about the full year comments I've made on CapEx, as well as the Q1 guidance of over $30 billion, you first have to ground yourself in the fact that we have $368 billion of contracted backlog we need to deliver, not just across Azure, but across the breadth of the Microsoft Cloud. So in terms of feeling good about the ROI and the growth rates and the correlation, I feel very good that the spend that we're making is correlated to basically contracted on the books business that we need to deliver, and we need the teams to execute at their very best to get the capacity in place as quickly and as effectively as they can. And so when you look, we've talked about the growth rate will decline year over year, but at its core, our investments, particularly in short-lived assets like servers, GPUs, CPUs, networking, storage, is just really correlated to the backlog we see and the curve of demand. And, I talked about it, in January and said I thought we'd be in better supply-demand shape by June. And now I'm saying I hope I'm in better shape by December. And that's not because we slowed CapEx, even with accelerating the spend and trying to pull leases in and get CPUs and GPUs in the system as quickly as we can, we are still seeing demand improve. And so I am not as focused, Cash, on trying to pick a date at which revenue growth and CapEx growth will meet and cross. I'm focused on building backlog, building business, and delivering capacity, which we are seeing has a good ROI today in terms of our ability to get that done. So I don't want people to get overly focused on a pivot point, because when you're in sort of these expansive moments, picking a data point usually means you're going to pick to be too conservative in terms of market share gain and in terms of winning. And so I tend to put my energy more there.
Yeah, I think one of the other things, Cash, is that I think I said this in a previous earnings as well, which is the difference between a hoster and a hyperscaler is software, and the same is going to be true here. That GPT-4o example I gave is all software, right? The optimization even in the last year. So we know how to use the software skills to take any piece of hardware and make it, multiple X better. And so that's kind of where the yield will come. But as Amy said, while you're really going and building out the plant, you don't want to sort of serialize it. You just want to go in parallel on all of these fronts, and that's sort of what will compound over time.
And I do think it's important when Flex talks about the software layer, he's talking about in his comments to connect this back to the compounding S-curves. And so I would remind people that is something that we saw through the prior cloud transition. It's how we operated through that one, and the same sort of skills and logic done at an even faster pace is what will apply this same transition.
Sounds very encouraging. Thank you so much.
Thanks, Cash. Operator, next question, please.
The next question comes from the line of Michael Turin with Wells Fargo. Please proceed.
Hey, great. Thanks very much for taking the questions, and congrats from me as well on the metrics working in concert here. Amy, maybe on margin, impressive to hear expectations for flat operating margin in the upcoming year as you absorb some of the mix shift towards Azure and some of the more AI-focused offerings. Can you speak in more detail just around your ability to manage those trade-offs and offset some of the mix shift? And I'm wondering specifically just on any productivity gains you're seeing from leveraging AI internally that you'd highlight, or anything else you'd just mention in underpinning the full year expectation there. Thank you.
Thanks, Michael. I think really the area to focus on is when you think about margin. I think sometimes people get a lot of energy around cost control as a driver of margin. The other driver is to focus on making sure you deliver great product that's competitive and innovative and can take share, because that drives revenue. And revenue itself and revenue growth, as you all know better, even perhaps than I do, is a durable way to see margin improvement. it builds on itself. That being said, the second thing I would point to is really what I talked to Cash a little bit about before, Satya and I both mentioned it, is applying all of our skill set here to deliver efficiencies, whether that's at whatever layer of the stack that exists. The S-curves compound, and we are doing that work, and we're focused on it. At the same time, we're doing the build-out. So you'll see improvements there even as we continue to invest. And then, of course, it's about continuing to have great talent here, focus on products and opportunities where we have the biggest markets and the most likelihood of success. And so when we have those three things happen and the energy is right and the focus is there, it gives me confidence in terms of margin delivery. But make no mistake, it starts and ends really with product, which is what we're really focused on here and delivering that to customers.
That all sounds pretty good. Thanks very much.
Thanks, Michael. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with you all soon.
Thank you.
Thank you.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.
All right, folks, thanks for watching the Microsoft fiscal year 2025 fourth quarter earnings call, brought to you by Traderade.com. Definitely a lot of upbeat discussion there. The stock is trading up over 8% after hours. Meta also up quite a bit, over 11% after hours. Looks like we're up for another day of setting all-time highs in tomorrow's trading, and we have Apple and Amazon earnings in the evening. So tune in, as I'll be covering probably Amazon, but we'll see what the folks out there say in the voting. Thanks again for tuning in, everyone. Appreciate it. This has been Markets and Mayhem from Traderade.com. Check us out on the web, learn more about what we're up to, and I'll catch you soon.